Tariffs, to some extent, are an act of war. Over time, they become a tax on goods, said Warren Buffett, one of the longest-standing investors in the U.S. market, in his assessment of Trump's trade policy. In his ironic remark, "It will be the tooth fairy footing the bill. Punitive tariffs could spark inflation in the US and harm American consumers. So fears have become reality. US tariffs on goods from Mexico, Canada, and China have officially come into effect. However, before making his announcement, Donald Trump effectively held the markets in a suspense until Monday evening. Retaliatory measures from Canada and China will follow shortly after. For reference, Trump's tariffs on Canada and Mexico cover more than $900 billion in annual imports. Given the deep economic integration of North America, disruptions in logistics will deal a serious blow to the region. The more vulnerable the U.S. economy is, the higher the forecast for a rate cut by the Fed Reserve. Now, traders are pricing in 3 rate cuts by 25 basis points each this year. Just a few days ago, the expectations was for 2 rate cuts, and a month earlier, only 1. Here is how the FEDWATCH tool projects the situation for June 18. On the other hand, the newly imposed tariffs will drive up consumer prices in the US. Goldman Sachs estimates an increase of up to 0.7%. A surge in inflation could force the Fed Reserve to keep interest rates at elevated levels or even raise them. That would be a bullish scenario for the US dollar. However, the U.S. economy is looking increasingly fragile. As a result, the 6-currency dollar index has got stuck under bearish pressure, consolidating within the range of 106.2 to 106.7 today. Next, in line for the Trump's trade strikes is the European Union. However, judging by the movement of the euro-dollar pair, the market still holds on to hope that the tariffs will either be postponed or quickly cancelled. At the same time, high demand for the euro-nominated assets is driving capital outflows from the US to Europe, lending support to the euro. Another bullish factor for the single currency has been the decline in oil prices. As a result, the main driver of the greenback maintained its bullish momentum for the second day in a row, trading within the range of 1.0474 to 1.0526 today. However, given that the euro strength is partly driven by hopes for a peace agreement with the Ukraine, its upside potential remains limited. Moreover, the European Central Bank is expected to lower its refinancing rate again this week. You can find out more about the timing of this event and other economic data and their possible impact on the markets in our traders' calendar. As for oil prices, we were too quick to assume that Donald Trump had forgotten about them. On March 3, OPEC Plus countries announced plans for a gradual increase in production. Whether under pressure from Trump or on their own accord, the cartel unexpectedly decided to raise output starting in April after more than 2 years of restraint. Initially, production will increase by 138,000 barrels per day, with a total recovery target of 2.2 million barrels per day by 2026. As a result, Brent crude prices retreated to last year's lows, hovering around $70 per barrel. From a technical standpoint, Brent crude faces the risk of short-term declines even further. The decline in oil prices has so far had little impact on the Russian ruble. The ruble currently tends to react more to favorable auctions from Trump's administration. The baseline forecast range for the dollar-ruble pair in March is between 85 and 93. Considering that demand for the US dollar in the Russian market may increase, its bearish trend against the ruble could continue this week. So that's all for now. We continue to follow developments in the financial markets. Subscribe to our channel and follow news with us. See you!